Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 176. Now, today we're going to cover a handful of economic news. We're going to take a look at Facebook, WIN, we'll look at the federal interest rates, the yield curve, and talk a little bit about China, and just overall the economic factors that are moving the markets. I'll also share with you my insights on the technicals, meaning the charts of what's going on underneath the surface and why I think there could be some major trouble ahead for the stock market. And I'll give you a few quick bullet points of why this is my thought process. Obviously, it's not going to be a thesis, but I'll just share with you my thoughts and ideas and areas of concern. So with that in mind, I'm going to get started here in just a second. I apologize for any coughing. I did get sick this last week, so my energy is a little lower. I caught my son's cold there, or sickness, or whatever he had from last week. So in either case, please bear with me. Let's try and make it through together on this Let's Talk Stocks episode. And if you can't see the charts when we start going over the charts, be sure to join us on YouTube or the website at tradersfly.com. So with that in mind, let's take a look here at Facebook. Facebook's a big mover over this last week. When we look at Facebook, it's had some scandals here that was in the spotlight. Basically, there's been a data breach and data problems and misuse of data. And this stock is selling off in a big way over the last few days, basically over the last week. But there's still people that say that this is a buying stock. And I still agree it is a buying stock, but at the right price. And what is that price? So if we take a look here at Facebook and we look at the charts, I'll give you the longer term picture and perspective. Now, overall, if you've heard me going through some of the courses that I've talked about and you've looked at the steepness of the growth of the chart or the steepness of the price. The faster you have a growth, let's say you have a growth right here that we have. This is our yellow line and we have a growth at this angle of elevation. Okay, so we're moving at this speed. Certain things have to happen in order for you to move at that speed. And if the company continues to do well, then you can continue to move at that speed. Now, what happened with Facebook is a little bit later through this period, we accelerated that movement, and that movement started to accelerate in this big way. So when we now look at that angle has become much steeper, nearly double, if you look at percentage terms, twice the speed, which means you're really set up to be cooking and flying high. So this was a little subtle problem, but when all things said and done for the year, it was doing quite well. But now you can see eventually things caught up to the company. And now that we've broken this level right there at that price point, which in this case will be about 173, 170, that stock is in a bit of trouble. You can also, of course, note the volume, the bearish volume picking up right there recently, which also is causing a little bit of trouble for the stock. Now, if we get back to a normal level, a normal angle, which is this yellow line, this steepness, I'd say that's about a 50-degree angle, and we come back into this price level here and bounce, then I think we should be okay. But if you're trying to sustain the second level, this acceleration level, it's going to be very difficult to keep it on its path that way. So this is why I look at it and say, hey, well, if we get into about 150 and then start bouncing, I think that should be okay. Now, if you roll over at this level, at this 150 angle, and this stock starts to break down, and we go lower and we come back and retest it and start heading lower, that's where you get into some trouble, where that stock can get into that $100 level, $75 level, get cut in half basically at the $80 level, and still be okay because that's a standard retracement or pullback. So you can look at that line right there, that angle of elevation, a 50% pullback from here to here. If you look at it, we're at 180 now, or at the highs 180, 190, so a 90% or a $90 level should be, about a 50% pullback, and that'll put you kind of somewhere over at this price point. So that doesn't mean it can't happen. It just means, if you need the stock to be bullish, you got to stay in this line. If you're okay with it breaking down and you want to even monster pullback, then, well, you can pull back beyond the 150 with volume. If that continues to grow and fear continues to grow, then that can easily happen. And if this one goes along with other companies and they all start going together, well, that can create more and more problems. So that's kind of the first main thing that I wanted to cover. Also, when we look at WIN, Steve Wynn started selling part of his shares, about a third, I believe. And when we look at Wynn, that company over the long term, okay, so here, let's take a look at the weekly. You can see we had a A to B between 2009 and 2015, ABCD pattern. Then we had quite a bit of sell-off from 2014 to 2016, good digestion periods in between, and then finally breaking out past that $110, $120 level to where it got back into around the 200 level. Now, 200 was a little bit stretched in my opinion for the speed for 2017. Again, look at that angle, how fast that is. I would say a better angle would be something along the lines of this, or really if you take a point all the way in the back over here and draw it, that's a much safer angle. So anyways, when we look at these angles right here, we were accelerated quite a bit, and again, we're struggling, so a little pause is expected. Obviously, we're looking at the daily, so if you're looking at the daily chart, somewhere around 160 could be a nice support level, but right now that stock is struggling at 190, 200. You have some resistance right there because you had a massive pop, a little too far accelerated, sell back, again, a secondary pop, and now it's pulling back again. So overall, somewhere around 160 at that support level is what you're watching. That's also around the 200-day is around that 150 level. So that's where the stock could find some shorter term support. If you're looking for a long-term overall path, I mean, looking at the angle, you could say 150 is where it should be. So if it pulls back a little bit, you're still kind of in that range. But this, again, depends on the overall market and how that plays out. Which brings me to my next point of the Federal Reserve and kind of the interest rates. They basically raised rates. They talked about saying, hey, we're going to raise 3 times this year, probably at least, and they may raise 4. They didn't say 4 right away, so the market was pretty happy about that. And if you look kind of on the intraday on the market here, where was it, yesterday, you can see, let's bring it in right here, that we basically had a lot of movement right there. So first, people were very happy because they thought, well, it's not going to be 4, it's going to be only 3. So the market was up like 20, 30 points. And then all of a sudden, you get this massive pullback because then they start talking. Jerome Powell there starts talking. And he starts talking and is saying things. And now they're saying, whoa, whoa, whoa. Now you're starting to accelerate things even further. And throughout 2019, 2020, so that could create more trouble. Now, this market, as you can see, didn't digest it very well because then also coming in, when we look at this next day, today, we were down 35, 55, 50 points. At the open, we're down about 20, but then this continued to accelerate. Now, this also is in line with, you have Trump talking about trade wars, of course. Well, not trade wars, but he's talking about imposing more trade problems with China, which the market's then worried about, retaliation from China. And of course, this is the whole big premise of why they have things like the TPP, is so that one country is not too big. You have a lot of countries, smaller countries. That's what the Europeans did. They have the EU, where they joined forces together, where now you have the euro instead of just, one kind of currency for every different country. Now they can negotiate trade and have a little bit of stronger power. So instead of 100 different countries trying to negotiate trade, you have one region or area. 5 to 7 kind of regions is a lot better than, let's say, 100, because then the bigger companies or countries can take advantage of the smaller countries. And ultimately, I think those things like the TPP work out really well in concept. Obviously, between the deals and country to country, they may not work out as well on paperwork, but the concept is the right approach. So here, when we look at imposing additional tariffs on Chinese goods, in the end, just like we mentioned this with the steel and aluminum, it just will get passed back to the consumer because China is going to go ahead and impose other tariffs and rates and those kinds of things, because we get a lot of things from China. Americans would not have the lifestyle that they have unless they got their goods from China, because we're basically using the labor force from China, from all the cheap labor that they have over there, from even the sweatshops, God forbid, to all the other things that happen over there. And we're ending up buying all these goods. And half the time you don't even know where this stuff is made, and you think it's made somewhere in a good factory, but it's made in China. Or they might even have secondary factories where they make it in, let's say, a sweatshop. That sweatshop in China moves it over to another Chinese factory that's a little bit more legitimate, and then that ships it to the US. So now all of a sudden you get it from a secondary company from China, which may not be as bad as a sweatshop, but it's, they're buying it from all these other areas, and it really just creates, problems for us in the long run if you're looking for cheaper goods economically, because a lot of your products and goods are still coming from China. If you're looking for quality of life, looking at from the digital technology that you use, all these things will be raised higher in prices. And not to mention then tariffs will be imposed on other things when it comes to, you look at these things like potential soybeans, that Chinese people could impose tariffs on those, or things like Boeing or Apple, silicon chips, your phones, devices. So this could create a little bit of a problem for Americans, especially since if you're used to living a certain lifestyle, So anyways, with that being said, just be aware that these types of things are never good for growing an economy, right? The way that you grow things is to add value, just like with a business, just like we do here on video. You add value, you contribute. So rather than, hey, let me stop you or create a barrier or border wall or anything like that, it's more along the lines of, how can you grow someone? How can you help them to where they help you, creating a win-win relationship? Very little do you hear that from the administration. How do we do that, right? How do we create a win-win relationship with China? You don't hear those kinds of things. And, so this is why the market is struggling a bit. And which brings me to my next point, is you're starting to look at the yield curve here, where it starts talking about recessions, because this ties to the Fed. You're looking at the yield curve, and brings me to my next point of very deep concerns for the market, to the point where I'm calling, initially when I talked about the election, I assumed that having a Republican in House, not to be biased, but just the way that the markets move, having an extended market, and giving you some facts here in a moment, more than likely will lead to a recession. So here are my quick points, and then I'll go into detail of the charts and so forth. Basically, we had a very accelerated market. So that's kind of the first thing. When we look at the overall market of the S&P, now this goes along the lines with Obama as well, but we've had a very accelerated market. No matter how you look at it, the market is very accelerated. So between 2009, to all the way now, the market's extended. Since Trump took office, this curve started to come up even steeper, like a rocket ship, because of tax cuts to the corporations and all these things. So that line, so initially you can look at it this way, but then we started to get this further acceleration right there, started to create some problems. So now what I'm seeing is that with that acceleration, you could have some serious pullbacks and problems, because remember, markets power up to the upside much faster, and they get extended, and then they pull back. And the same thing, when they sell off, they get extended as well. With that in mind, with a low VIX that we've had over the last 6-8 years, and the very low VIX over 2017, the yield curve starting to flatten a bit, then we have all the debt that America has that constantly is growing, not paying it off. China doesn't want to buy our debt. You have rising interest rates. So many factors are starting to contribute to higher and higher degrees in potential of recession. Will it happen during Trump's presidency? I don't know. It may happen in 2 or 3 years still, when this starts to unfold in the marketplace. But you can see that the tone has changed very quickly. If you've been trading October, November, December to now, just in the last few months, you can see the tone has changed. And I'm showing you right here that this line, when we have this, if you know about A to B, B to C, C to D patterns, this line right here, this already broke today. Now, if this breaks in a sustainable way, wide price spread volume, and it closes below it, we could have serious issues. Now, we do have a little gap, which may get filled, and we may get a counter trend bounce here. But if this starts to break further, you could get a ABCD move right here, which now would take you basically right here. Let's see here. The lows over here is 333. So taking 333 down, you could go to about 2450 is what you could get, 2460 on the S&P. Now, getting into 2450, 2460, when you get into that level, that starts to roll this over. Okay, now could we then get stuck right here, kind of in this trading range with a slight pullback for, let's say, a year or two? Yeah, that's possible. But already going on 9 or 10 year bull market here, you know, statistically, and now Federal Reserve raising rates, the VIX has been so low, I believe it could have some more detrimental issues because of spending issues that we have. The debt problem, Americans are just not paying back their debt, meaning the government, right? They're not budgeting. I mean, what is it, $3 million for a refrigerator and an airplane? You could buy one down in Lowe's, Home Depot for a couple $1,000. So come on, get real, get smart. Anyway, so looking at these things, and you start combining this with Apple, $180 resistance, it's just struggling. You look at these big companies, and tech, this is the issue, is that when you had tech, such a leading area, doing so well, what area is going to really take it over? Yeah, I mean, you have self-driving cars, but that's, again, technology. You know, you could have, what, the healthcare industry? You think the healthcare is going to go get better after all the healthcare debate that we just had with the Obamacare, Trump care now? You know, so with tech under pressure, you look at Amazon now also struggling. If this breaks this level here, you know, you could see it's slowly rolling over. And the volume here is picking up. Look at Facebook. This is what we just talked about. You know, you look at this chart here, and you can see, boom, big volume bar selling off that consolidation. Big trouble right there. And now we're getting into this price level where if this breaks, you're back into that long-dated, long-term 150 level. So that's another $15 lower from here. So again, that's an issue. You look at Netflix, a big-time leader, but again, slight little pullback. Now, this is all minor, right? Right now, relative to the big picture, you could say this is a healthy pullback, right? You could say this is normal. Stocks don't go up straight up every day. Yeah, absolutely, this is true. And of course, you might get back into this right here and bounce. And just like with Apple, you might get into this 170, this gap right here, and bounce. You might even get back into this 155 level and bounce. And then it could go up higher like Apple and the S&P for another year or two. But just understand that you're starting to reach some stretched levels. The further you stretch something, the more likely it's going to pop. Now, you could keep stretching things for a long period of time if you go slow, right? If you go slow, like let's look at Johnson & Johnson or PepsiCo, for example. Like, look, this stock, you could stretch it for a long time if you go slow, right? You go slow, a little pullback, right? A little slow, oh, my leg hurts. A little slow, my leg hurts, right? You could see this one was a little quicker, right? So the faster you stretch it, look at the angle. The steeper that angle, the more likely you have a pullback. Steeper angle, well, what's next? Come on now, come on, not rocket science. So that's what I want you to think about, is that as we start looking at these things and you look at the overall market, right? So initially you have these things and then slight little pullback, all right? I can't even draw it. Little pullback, slight stretch, okay? The further you stretch, the more of a pullback. Further you stretch, more of a pullback, right? Because you need recovery time. Can't just get into a split in a day. So same thing here, right? So if you have this massive stretch, you got big debt, you got rising rates, you got trade problems. All these things don't really help the markets feel at ease, and with stretched valuation. So sometimes what the good ideal approach, if you're looking for the trade, is to really just give it 3 to 6 months. Be patient here and put your time into your studies and just watch and learn. If you're not used to volatile markets, just be very careful. Trade lighter. Trade a third of what you normally trade. But overall, it's a great learning experience and a good time to be patient. And especially if you're like 18 years old, 15 years old right now, and this thing pulls back, let's say to 1,500, take all your money and you buy it as much as you can, because in the next 30 years with inflation, it'll continue to ride up. Just like, if you bought it somewhere over here, it doesn't even matter if you bought it a little high in 2001 at the dot-com bubble, right? You still would be way ahead right now 20 years later, right? So think about the bigger picture if you're looking at it that way. Anyways, that's just kind of my thoughts. I wanted to share that with you. I hope you're having a good day. For me, I'm still sick. We have a couple of things I'm working on between the website stuff, some of the option courses that I'm filming. So those are some of the things we're working on. But I hope you're doing well, your family's doing well. Thank you so much for joining me in this week's episode. Stay well, stay healthy, because there's more to life than money. In the end, though, do what you enjoy, do what you love, do things that you can contribute to, and most importantly, live your life to the fullest. Thanks again, and I'll see you next time.